Welcome to This Explainer. I am so glad you're here. Let's just dive right in, all right? We are putting together the absolute ultimate survival guide for retail investors today. If you've ever felt like navigating the financial markets is like walking blindly into a wild, unpredictable ecosystem, trust me, you are not alone. It is a jungle out there. But today, we're going to decode it. We're breaking down the mechanics, the language, and most importantly, the psychology you need to not just survive, but to actually thrive. Here is the agenda for today's explainer. 1. Decoding market lingo. 2. The hidden costs of trading. 3. Navigating charts and trends. 4. Strategy and risk management. And finally, 5. Surviving the tilt. All right, Section 1, Decoding Market Lingo. Let's understand the slang. So if you've spent, any time at all on investment forums, you've probably caught yourself wondering, do I actually know my bulls from my bear whales? This terminology can sound completely alien to outsiders, right? But these aren't just silly internet jokes. They're actually shorthand for deeply ingrained market behaviors. Let's take diamond hands, the ultimate sign of steadfastness. It basically means holding onto an asset through brutal volatility because you're confident it'll bounce back. It's a badge of honor. On the flip side, we've got paper hands. That describes an investor who panics, folds, and sells at the very first sign of a dip. And then we have this whole animal ecosystem of trading. So we all know the bulls, they're the optimists driving prices up, and the bears, the pessimists making money on the way down. Then you have whales. These are institutions or even individuals with so much capital that their trades literally make huge waves in the market. You've also got apes, a community-driven group whose absolute favorite strategy is just to hold on tight until the price goes to the moon. But I really want to draw your attention to the pigs. These are the greedy, high-risk investors who completely forget their strategy. And, well, as the old Wall Street saying goes, pigs eventually get slaughtered. Which, honestly, brings us perfectly to our next section. Section 2, the hidden costs of trading. The invisible fees. You might be thinking the only cost to trading is your broker's commission, but that's just not true. Think about it like this. On every single trade, there is a bid price, which is the highest price a buyer will pay, and an ask price, the lowest price a seller will accept. The difference between those two numbers? That's called the spread. So if a stock asks $175.52 but bids $175.50, that tiny 2-cent difference is the spread. That is the basic fundamental transaction cost of trading, and it's exactly how market makers secure their profit margin. Another hidden cost that's just going to eat right into your profits is slippage. Slippage happens when the actual execution price of a trade ends up being different from the price you expected when you click the buy button. There are 3 main types here. Price slippage happens in really fast-moving markets when the price jumps before your order actually fills. Then there's liquidity slippage, which is when your order is just so massive it eats up all the available shares at the best price. And finally, execution slippage comes from literal milliseconds of delay in network processing. Basically, in a highly volatile market, the price you see is absolutely not always the price you get. Now, if you combine those mechanics with human behavior, you end up with classic traps like the whole buy the rumor, sell the news setup. Walk through this one with me. First, rumors of a great earnings report spread, right? So the stock rises. The market acts as this giant discounting machine, meaning that expectation is now completely priced in. Then, when the positive news is finally officially confirmed, guess what? There are literally no new buyers left. So all those early buyers sell to take their profits, and the price plummets despite the supposedly good news. If you buy on the day of the good news, you're pretty much just becoming the exit liquidity for those early investors. Ouch. Section 3. Navigating charts and trends. Navigating the market. So technical analysis is basically built on the idea that history tends to repeat itself, and that all known information is already reflected in the price. The absolute foundation of this map are support and resistance levels. You can think of these as invisible walls just bouncing the market around. Support is your price floor. Buying interest is so strong here that it stops the price from falling any further. Resistance, on the other hand, is a price ceiling. Selling interest is so heavy it literally stops the price from rising. But what exactly happens when those invisible walls finally shatter? Well, a breakout occurs when the price decisively smashes upward through a resistance ceiling. A breakdown is the exact opposite, crashing downward through a support floor. When these key levels break, it almost always signals the start of a major new market trend. And believe me, professional traders watch these moments like hawks. We can actually visualize all this price action using candlesticks, where every single candle tells a micro story of the battle between buyers and sellers. A doji has a tiny little body, which shows total market indecision. Nobody is winning. A hammer has a long bottom wick, showing that sellers tried to push the price down, but buyers fought back hard and took control. And a shooting star shows the exact opposite scenario. Buyers pushed it up, but sellers aggressively slammed it right back down. But here is the hard, cold truth of the market jungle. No matter how incredible your charting skills are, setups fail. Support levels break when you absolutely don't want them to. So I have to ask you, what happens when the technicals completely fail and a trade goes terribly against you? That brings us to Section 4, Strategy and Risk Management, your ultimate shield. Listen, if you take away just one number from today's explainer, please make it this one, 2%. This is the absolute golden rule of position sizing. It means you should never, ever risk more than 2% of your total portfolio on any single trade. Now, notice I said risk, not invest. If you have a $10,000 portfolio, your maximum allowable loss on a trade should never exceed $200, period. This is how you ensure that a string of bad luck won't completely wipe out your account. So how do we guarantee we only lose that 2%? Well, by using a stop-loss order. Let's look at a quick example. Say we see an asset breaking out of a downward channel. If we buy at $5, we don't just, hold and hope. We place a mechanical stop-loss right below the prior swing low, let's say at $4.60. Doing this limits our potential loss to exactly 8% of the trade size, which allows for normal market wiggles while hard capping our catastrophic risk. In a slightly different scenario, maybe an asset is bouncing along a support line. Instead of just putting the stop loss at the exact previous low, we set it just a little bit below that broad key support level. This prevents us from getting stopped out on some minor, totally random dip, but it firmly pulls the ripcord if the asset truly breaks down. By placing these mechanically the moment you enter the trade, you completely remove that panicked, emotional decision-making when your screen inevitably turns red. So the crucial point here is balancing that strictly managed risk with your potential reward. We call that your reward to risk ratio, or RRR. You really want to target a minimum 2-to-1 ratio. That means you're aiming to make twice the amount of money you're risking. So if your stop loss risks $200, your profit target needs to be at least $400. If you consistently maintain a 2-to-1 ratio, you can actually be wrong on more than half of your trades and still be profitable in the long run. It's just pure, emotionless survival math. Section 5, Surviving the Tilt, the Ultimate Boss Fight. Now, tilt is a term originally borrowed from poker psychology. It describes a super dangerous mental state where your emotions, usually anger from a big loss or maybe frustration from missing a great setup, completely override your logic. When you're on tilt, your trading plan essentially shuts down. You start revenge trading. You double your position size because you want to win it all back. You start ignoring your stop losses. It's actually a biological response. Your brain's primitive fight or flight center is literally taking over your prefrontal cortex. This is exactly why it is so vital to internalize this one concept. Losses are data, not judgment. When you tie your ego and your self-worth to your P&L statement, every single losing trade feels like a personal attack, and that immediately triggers the tilt. The best traders in the world, they view a trade like a science experiment. A loss simply invalidates the hypothesis. It's just data. It's feedback, not a failure of who you are as a person. Because of that, you absolutely need a concrete action plan to protect yourself from yourself. So here are 5 highly effective techniques to help you avoid the tilt. Number 1 is non-negotiable. Create a hard stop trading rule. If you lose 3 times in a row, you walk away from the screen, period. Number 2, journal your emotional triggers. Did you trade poorly because you didn't sleep well? Write it down. 3, use strict routines before and after you trade to maintain your discipline. 4, practice mindfulness so you can catch the anger before it totally takes over. And 5, like we just talked about, aggressively separate your self-worth from your trading results. The financial jungle can be incredibly rewarding, but let's be honest, it is entirely indifferent to you. The market doesn't care about your feelings, it doesn't care if you're having a bad day, and it certainly doesn't care about your need to make money. It just moves. So understanding the lingo, mastering the charts, and calculating your risk, all of that means absolutely nothing if you can't control your own mind. Now that you've been armed with the mechanics and the psychology used by the professionals, I have to leave you with this final, vital question. What is your survival plan going to be? Thanks so much for joining me for this explainer. Get out there, map your charts, manage your risk, and as always, keep learning.